We are back with another episode.
It always baffles me how some people don't ask as much questions as they can.
But I always say my repeat customer is my clients, so my investors.
Why is it not performing the same it was last month or the month before?
Number 11 on
Yeah. It could have been worse. You could have been walking around with a shit haircut as well.
Yeah, that's got better, mate. That's looking all right.
Your hair is coming on leaps and bounds.
Yeah, there we go. There we are. See, yeah. Butchered barber is now returned.
Roundup sound, ooh, yeah. Real estate deals. We lay them down, let's get those deals. Deals, making money, baby.
We are back with another episode. And we got Ronan with us today. Ronan, what's up, mate?
Good morning, boys. How we doing?
Top of the morning with you.
I'm just after playing some piano there this morning while I was waiting for you guys to come on.
Yeah, beautiful, mate. Like the background. Well, yeah, we got Ronan today, guys. And Stuart is down in Devon. He's down on his last week holiday of the summer until he's back into full action for the rest of the year. And then Big D is going to be back in about 5-10 minutes. And this episode is going to be very much us going through a lot of your questions, the audience, a lot of your questions we've taken down from Instagram, YouTube, things like that. So there's all sorts of topics we're going to dive through, and we are going to see if we can elaborate on them in any useful or meaningful way. But yeah, that's it. What are you saying, Jack? How's life?
Yeah, all good, all good. What I would like to say for our listeners is it always baffles me how some people don't ask as much questions as they can. What all of our listeners have got to remember, like if I want to borrow an hour of Dorian's time or an hour of Ryan's time or an hour of Ronan's time or an hour of Stuart's time, it's going to cost a lot of money. So get your questions in. You've got all of our heads on it, answering it for you. And hopefully you'll be able to, what's your one biggest problem in your business? Think what's your one biggest bottleneck and get that over to us. Because I'm not saying that we will be... we're going to change your lives, but you're in a good place for that to get hopefully ironed out to get you on your merry way to success. But yeah, all is good. All is good. We're weirdly, I feel like a developer at the moment. Like I feel like the last 6 years, all I've done is pushing planning and pushing legals and pushing banks.
You must be closing sales now.
Negotiating and all that sort of nonsense. But we're actually like wellies on site, all at like strip out first fix like phase on all of our sites. So if you went around all of our sites, it actually looks like we're developers at the moment. Whereas I just feel that we spend most of our time just pushing people around because they're just slow, haggard and boring.
Yeah. There's a lot of paperwork in there that just makes you feel like you're an administrator for a while. And then it gets fun.
Yeah.
It's good being on site.
But I completely agree with what you're saying in terms of the there's 2 hours here where you could ask us any questions possible, because I do it to you guys. Like the amount of times in the group chat, we'll just ask each other stuff. And I know that if there's an answer I need for something, I'll go to you guys first. And then if not, then I'll go to someone else in the network first. People who've been there, done it. And it's the quickest way to get a good feedback loop. Speaking of feedback loops, Ronan, I can hear myself. I can hear myself going.
Right.
I can hear it too.
Let me plug this out and see does it work better.
Yeah, you could also mute when you're not speaking.
Yeah,
which is a bit boring, but there is actually a shortcut for that. It's on my computer. It's Command D, which I
Command D. I don't know what mine is. How about now, Ronan? If you talk now, you're muted.
We'll have to use that. We'll have to use that shortcut as the code word for it is Dorian's wife. Command D.
Is that better or worse?
1 2 1 2. Yeah, that's fine now.
1 2 1 2. So it's just off my laptop. So apologies if the sound is a little off. It's just
that's all right, mate. Yeah, that should be fine. It's the headphone. Like on the first episode we did, we had we didn't have the headphones in. We all had these good mics, so we sounded great. But whenever one of us was talking and the other one was, it was a shambles. And the headphone just sort of mutes all of that out, so it makes life easier. But yeah, I've got a question for you two actually before D comes. Yeah, big conversation we're having in-house at the moment. Oh, wait. D's here. I'll ask D as well then. Big D!
Hello. Apologies.
Dorian, how are you this morning?
How's it going? You okay?
All good. Waiting for your grand arrival.
And he's here.
Can you like the piano in the background there,
I
Ronan?
tell you, I've worn my hands out on it.
I said the same thing to him. Oh, D, you're wearing a different top, mate.
Yeah, well, I've been
changed.
away for the past. I've been away for the past few days, so I've used all my white tops out. So I've had to go to the black tops.
Black top.
Are you going to struggle to remember your name, this one, because it hasn't got your name on it?
I am, yeah, unfortunately. But I tell you, I wore that. So those that don't know, my staff bought me a Castell white top with my name on it as a kind of like a joke thing, because all I wear really is Castell tops. And I wore it because to show them, I can take a joke. But what I didn't realize, I had a day of meetings, or probably didn't just take notice. And then in some of the meetings, I was wearing the top, and then I also had to go to school and pick my son up and stuff. So walking around and having meetings, and I never had explained to anybody why I was walking around with my name on my top. But anyway, if they watch this, they'll find out. I'm not just a weirdo.
Yeah.
Well, Big D, yeah. Big D.
It could have been worse, D. It could have been on your back. Number 11 on it.
Yeah.
It could have been worse. You could have been walking around with a shit haircut as well.
Yeah, that's got better, mate. That's looking all right.
Your hair is coming on leaps and bounds.
Yeah, there we go. There we are. See, yeah. Butchered barber is now returned.
Big D, you came just in time, yeah, because Jack was just raising an interesting point that for any of the audience watching, this is a very useful space to chuck any questions at us that they may want answers to, or that they're struggling on, things like that. And we spoke about how we want to try and be useful in that way. And I actually have a question for you guys, something we've been talking about internally at the moment in my business. At what point of revenue or at what point of ops should you have a dedicated accounts person or accounts department? Like, is there a turnover point? Like, when do you think that is the right time to bring in accounts?
Well, I'll jump in quickly.
Go on.
If you can sorry, I don't know if my connection broke up there.
You're good.
So in our company, Castell, my first employee was a coordinator / admin apprentice to help me with all of the administration of taking projects through, utilities planning, just collating documents, all that sort of stuff. My second employee was a bookkeeper. So I think you should get a handle on it as early as you can, but I don't actually think that you need to bring in a CFO or a finance director straight away. It obviously all depends on the scale and stuff of your business, but really the biggest thing that people lack, to be honest, and all they need is just good bookkeeping. That's what I would say, and you can get that in quite cheaply.
Yeah, because Robbie at the moment does all of our accounts across all the group businesses. And he's essentially our CFO. Like, that is what he does. But the construction. Was
he always there, Ryan?
What's that, mate?
Was he always there? Was he always part of the group, or did you just bring him in at a certain point?
No, he's always been doing that. So when we first started, me and Dad sort of managed that bit, and then as I got busier bringing in developments, like Dad focused more on the account side. You know what it's like when you start a business, you kind of take everything. And then when Robbie came in, he took over lettings and accounts when it was just the three of us. As we've built, Robbie has delegated all of that. Different staff members now take on different bits, and he's just accounts and finances. But the construction business now is going to hit about 5 mil turnover over the next 12 months. And we're starting, and then the lettings business as well, which is quite intensive with accounts. It's obviously nowhere near as much as construction. And then there's the other SPVs and other accounts and the sourcing business as well. And I'm just like, do we need a dedicated accounts person? I don't think 5 mil turnover is enough in the construction to have a full-time one yet. Maybe I'm wrong with that, but if they're split across the group, maybe we should. But it's basically a weekly conversation now. Do we need to split Robbie's time up and allow him to do some more higher level financing and just get an accounts person to do the gritty stuff? But
I think it depends on your setup and stuff. I know for me, when I started out, I would do all the invoices myself. But what gets tricky is even things like the VAT and what we have in Ireland called RCT, which is the reverse charge of the VAT, essentially.
Yeah.
So that stuff you have to get right, and obviously you want to get some of that cash back, etc., etc.
Yeah. We do all the VAT
So
accounting.
I had an accountant who was essentially a consultant, and he's been with me for the last 10 or 12 years. He's actually an accountant with a bit of a tax background. So he's still with me now, but I'm probably at a point in the next 4 or 5 months to actually get a CFO in as we ramp up. But initially, the first couple of years, we just had simple Excels. Okay, we had a Sage product. We used to print that out and obviously go through invoices and stuff like that, and then send that at the end of each month to my accountant. And he would go through it. He'd check to see is anyone on that I'm paying, if their taxes are skewed, that you have to hold payment back, etc. So I think it's very important at the start because you have VAT elements which you need to deal with, but it's only a small sum because you're only using them for maybe a couple hours in a month, and then it goes into a different thing after, as you ramp up.
I to sort of concur with that. I think a bookkeeper is one of the best return on investments you'll have in your business. We actually, believe it or not, got our accounts in order way too late. XP was already a mini group, I would call it, of entities. We were probably a group turnover of over 15 million by the time we decided to really tackle it. And Ben and I were managing a lot of the cash flows ourselves. And what that then means is, although you have a good handle on it, your time is spent actually being a bookkeeper as well as doing other probably better monetized tasks in the business. So for me, it's actually, I feel we did have a fairly good handle on it, not to scale it, but where it was at, that sort of snapshot. But the time value of bringing in a bookkeeper replacing us is it completely invaluable. Both of us were spending the amount of time a bookkeeper would cost. I think our bookkeeping cost per month is 1,500 quid for 13 in our XP group, and then we've obviously got Central Suites and other businesses around that. So it's a no-brainer. Central Suites was turning over about 500k when we brought a bookkeeper in, and that's been a game changer into that entity too. What I would say is just I personally believe that if you are a self-employed contractor, so an individual that's a self-employed individual, you might not need bookkeeping sort of weekly or monthly. As soon as you go into employment and growing and you want to grow a business, I would say get a bookkeeper in. What we actually did is there's a product out there from a property entrepreneur called Josh Keegan called Ultimate Finance Directorship, where he basically comes into your business, builds all of the spreadsheets and forecasts and gets into the detail around your business for a one-off fee. And then he brought us in our bookkeeper who then works off all of those spreadsheets. So every week, if I go on any of our spreadsheets, they're current and they're forecasted forward. So we're never a week behind. Whereas a lot of businesses, you'd be amazed. I'd love to know the figure, but I would have thought it's over a majority that businesses out there in the UK that just do end of year to assess how their last year was and retrospectively look back. And that's what we did in our businesses to start, because you look at your bank account and go, well, more revenue has come in than costs. I know that I'm going to have to pay some tax out of the back of that, but I'm at the end of the year and we've got more money in our bank account than not. That's like the very layman terms. But as soon as you start doing forecasting, you can actually start thinking about, how can you grow the business? What's your cost per acquisition per customer? What cost do you save? Yeah, and actually adapt it. It's almost like, a race car not being able to do all the testing on an engine after it. You're just driving it around the track and going, feels fast, I reckon.
I can see D's
analogy.
D's face lit up then.
Here comes the car analogy. Yeah. Sorry, as I'm listening to this, great advice, by the way. I'm currently signing TR1s and I'm currently signing contracts for sale. It never ends, does it? For a meeting I have with a solicitor this morning. So apologies if you see me rustling around.
No worries, man.
Even
so moan about how hard it is.
I would have and 2 accountants, essentially bookkeepers, on my stuff now for 1 full week a month, and that covers my operation. So like even as you grow, like as JJ said, 1,500 a month as trade off to your time, it's an absolute no brainer. And then as you progress and it gets busier, that might move to maybe 3,000 a month or whatever. So I think you can keep pushing that along until your consulting cost annually is more or substantially more than what it would be just to get an in-house person.
Salary, yeah,
So
sure.
I'm at that transition point now of, well, the great thing as well about having a consultant is you can turn them off and on as you kind of please.
Yeah.
But as you ramp up, they can also add people to it. So, for example, I have two full-time bookkeepers now, albeit, sorry, they're a week a month. And then I have a tax guy and my own sort of holdco global accountant as well. He kind of guy has been with me from the start. But I use Zero guides. I was with Sage. I just find Zero better. I don't know if you guys what
Zero.
QuickBooks.
Same thing.
Zero
really.
for me.
We use Zero, yeah, and then you're using Procore as well.
The only reason I went to Zero was for Procore because it's easy. It's the best integration product for Procore
with SmoothLink, yeah.
Yeah, with SmoothLink, yeah.
Yeah. Fair.
So Ronan, just to touch on context, because I mentioned at what time we brought in bookkeeping, but so we're delivering £40 million worth of developments across the 13 or 14 businesses in XP, and that costs us £1,500 a month in bookkeeping across the whole board. So the value return on that is
the stress.
Why would you ever take it on yourself? Yeah.
Like, and then you have the query of, is it right? Am I getting my taxes right? It's just for somebody else.
What the bookkeeper does really well, and what I love in Central Suites, is they do a property itemization. So do a P&L per property. So all of the properties that we own are in one limited company. So a P&L on that limited company paints one picture, but they actually break it down in our management accounts to show each asset. So I can go, like, our team must hate it because I go, why is this property not performing? Here's a snapshot of its last 3 months and this month, and it's year to date. Why is it not performing the same it was last month or the month before? And then they go, oh, because we've got a problem tenant, or we have a void, or we had to buy a new washing machine, or the boiler's fucked, whatever it may be. And you can manage a property pretty effectively, because at the end of the day, we're all, the only reason we buy a property in the first place is to make a profit. And if it's not making a profit, there's a problem. And then you need to analyze that problem. So it enables you to sort of see that way through. Interestingly, I saw a talk with Tony Pidgley, the founder of the Berkeley Group, and he used to get P&L management accounts and project P&L exacts and forecasts and exactuals every week on every single project. So every week he would be in his boardroom and he would go through every itemization and be like, why is our groundworks 10% over budget on this particular site? And he would actually go to site and he would know that from the numbers. And then everyone would be shitting themselves because they've got to make that up on the job because they know he's got that down to detail. And when you're growing £1 billion development company, to know that detail is really, you're basically playing off the accounts team to make you look better. But he just loved it. He was just like immersed in it.
Yeah. So would your advice be then that, because at the moment Robbie's doing the full time, like we basically have someone doing full time accounts and finances and management, but we don't think that we probably need more like of a deep dive, and especially the construction aspect. But it's not a full time role. So would you say get someone in for just a bookkeeper for a week to update those accounts? Robbie can still do the high level stuff for that business, but we just have someone on, what you say, £1,000 or £1,500 a month on it.
Yeah, I would do exactly what Ronan said. Bring in a consultant that's paid per hour. So our consultant package for our bookkeeping is a bookkeeper. They log their hours, and then it's overseen by an FD at our firm. So we might have 2 hours of financial directorship in our business per month, but that it's overseen. So you just got to make sure everything's right, and that's worth the time. If that costs £300 in itself against the £1,200 for the bookkeeper to do, 20 hours, for an example, it's worth its weight in gold. And then you can scale up to the point where you just bring someone in-house.
Have you got a good recommendation?
Yeah, I 100% agree.
Yeah, I'll intro you to the firm that we use.
Yeah, if you could, mate,
and
that'd be
obviously
sweet.
just on top of that cost, guys, you're going to have your end of year financial statements. So, it's not just your 1,500. It's there's going to be additional costs for doing your statements.
But what I've learned is
if
your bookkeeping's on point. So our end of year used to be at the very beginning, I would export our bank statements for 12 months, send it to the accountant and let them fumble through it. Now they come and everything's organized, reconciled and in place. So their end of year is super easy. So they actually charge less for the end of year.
Yeah, well, we do the same really. If I was to do it again, 100%. But brought in a bookkeeper, as you've said, and there was a key kind of CFO, but ultimately they were a partner in an accountancy firm, and the accountancy firm itself would also assist and overlook our management accounts or filed accounts. But we would get some of these firms as well will also help train your bookkeeper in terms of coming in, helping set up cost code, helping set up templates for management packs, helping determine accounting policy, etc., etc. And then once that is kind of set, every month or every fortnight, whatever the frequency you want to do it is all the same pretty much. And then they're also at the end of the phone in for any query that comes up. But then really your bookkeeper and then eventually accounts assistant, and they're not on that much of a salary, should eventually be able to do all your payroll, VAT, draft management account, your management accounts and draft filed accounts for all your SPVs and main trading company and CIS returns.
Yeah, sweet. All right, boys. Well, look, there you go. That's been some useful help, and hopefully Jack send me this resource, and then I can get that over to Robbie, and we could maybe make some progress there without just hiring someone full time. Could sort of malinvest in that sense. So yeah, a consultant would be probably a good first step. So appreciate it, lads. And now we'll get on to the audience questions. So James, Ask You Official, thank you for your question, asked, does putting yourself out there on social media actually bring in deals? So, I mean, Ronan and D, do you do much? Do you get much through social media? Do you do much through socials? I know me and Jack do, but what about you guys?
We have because well, in short, the answer is yes. We do get lots of like deals that come through, but the problem is social media tracks the UK, and property development clearly is very in region specific. And if you're hyper focused in an area, which I do recommend you are, especially at the beginning, then the vast majority of leads that come in won't really be that useful. But remember, with property development, one deal can be 7 figures of profit. So it's kind of like you don't need 1,000. You just need to know that sooner or later, one, if you keep doing it, will come through. And that is the case with us. But the best thing for social media for us is actually, especially for LinkedIn, is that most of our deals come from agents off market and introducers, and a lot of them build trust with us and know us just because of our social media and so when a deal comes up, they reach out off the back of that.
Yeah. Ronan, what about you, mate?
On my side, I suppose it's slightly different. I've kind of obviously our end users when we're building homes is families and things like that. But I always say my repeat customer is my clients, so my investors. So my part of getting out on social media is a view or a channel for other investors who may want to come in and invest with us. So that's my target audience. Yes, it does help in bringing people to you, and it raises your profile. But in regards to sites, I think it doesn't make a difference to me because I generally have a good reputation. A lot of my site leads would come off market or directly from the agents. I have a good reputation for saying if I will buy, I go ahead and buy it. But definitely from an investor point of view, again, an investor with me will come in and do repeat business. So I really see them as my customers in respect of the social media channel stuff.
Yeah.
And that helps raise my profile. So that's what it does for me.
And Jack?
Yeah, I mean, it's one of those things. I interestingly asked a question, and I asked this question to all of you. If you had everything you need in your business, you had all the investment you need in your business, you had all the sales you need in your business, would you be on social media?
Yeah.
Yeah. But is a lot for us.
Ronan?
Probably not, but I'm old school.
Yeah, I'm the same as you.
I wouldn't really show my face to anything if I didn't have to.
Our customers, though, are housing associations and local authorities, and the deals come predominantly from agents. And
what I'm saying is, if you had every resource you need in your business, so the purpose of doing social media is for your satisfaction only.
Yeah, I do.
Nothing else. So
Oh,
you're
right.
not going to
Oh,
get
right.
deals. You
No,
don't need to do PR
no,
because your business
no,
has already got its own account. Would you be on social media?
Yeah,
no.
I would.
Yeah, I'm no.
Maybe I'm the only one.
Ryan, I know that out of the what do you call it? The values of wealth dynamics, you're definitely a star. Because that is, you know, a classic star like Madonna.
Well,
Like she
it's
thrives at her what's the phrase? The reputation precedes her. Same as you, Ryan. But I mean,
I mean,
so
I
for
would love.
me,
I would actually. So I would just as you, Jack, I would actually. You know, from as long if I didn't have to worry about like deals and clients in terms of like that side of things, um, and money. Obviously, those are the three things. I would much prefer to be a under the radar,
yeah,
not
Absolutely.
on social media,
yeah,
100%.
I,
yeah,
But yeah,
I
sorry,
think
Jack.
a lot of the media is actually, or sorry, a lot of this social stuff is for selling something, like selling courses or that. And like, I'm just not into that at all. And I don't think
yeah,
really experts are really selling that really many courses. They're just trying to fill a gap for something else.
yeah. Agreed,
Um,
agreed.
so
So to answer from my perspective, to answer James' questions from my perspective, I think that social media is one of those things that if you're not doing it, you are missing a trick. It's that exposure and that availability to be on the, you know, look at how many people buy a newspaper now. It's thin. You know, the modern way of digesting and sharing and learning is online. And I think that if you want to grow and scale a business, social media and media should be your best friend, especially because there's businesses out there that don't really know how to use it and they're getting old. And you
Mm.
can sort of swoop in there and make sure that you're ahead of the curve or part of it. From a deals perspective, we don't necessarily frequently go out there and get deals. I always say that we only leave our office for one thing, and that's money, investment. That is, because I can fall out of my office and bump into 6 banks, and they're all terrible. But we always look for investment. But what I would say, social media, I think is brilliant for, from a perspective of deals, is it always puts you at the front of mind of people. It's a very efficient, frictionless way to always be at the front of mind of others. And what I mean by that is if Ryan posts a video out and gets 50,000 views, it would almost be impossible for him to get in front of that many people in reality. So he's always reminding those people that he's there, he's buying stuff, and he's doing that. And it's really efficient because he's only shot the video once, but his time has been amplified by 50,000x and evergreen, forever growing. So
Yeah.
that is where I think social media is really powerful. So
Yeah.
you kind of got to be doing it.
My quick 2 cents on the deals part. Again, social media, just to answer for you, James Askew's asked this question. For investors, you absolutely want to be using social media. The social proof, the trust that effortlessly gets created with your prospective clients is phenomenal if you do social media right. So definitely in that sense. As for deals, we get a fair few deals that will come through social media. People hit me up in DMs, people send it to our email because they see me on social media advertising our email. But most of the time, those kind of guys sending you those deals are also sending them to 10, 20, 30 other people. So the quality of the deals and the sort of usually the dynamic with that person, the sourcing agent, whoever's selling it, they're usually quite rushed and pay me my fee quick. If you want access to the deal, do this, do that. So I don't think securing deals is the best way, but you can get some blinders through there. We had one come through the other day from a guy who works up in Durham, and he is a bit more exclusive. He'll only send them to specific developers. He won't just spam it out there. So for deals, maybe not as good, but for investors, definitely. The only reason I would keep social media, if it didn't have all the attributes Jack said, is purely that I filmed and documented my whole life pretty much online, whether just by happenstance or consistency or something. I don't know what it is, but I love that I can look back on my whole life just being documented in a given place for character development, growth, things like that as an individual, and also for your family to see, and the memories we can look back on that are perfect memories. We don't have to try and reminisce or remember something. It's, well, there it is, there's the memory. So there is another quality to social media. Sure, you maybe don't need to publicize it for that, but why not publicize it at the same time? But maybe I'm just a star. Anyway, next question. 5K3TY, thank you for your question. And this says, how can you get an accurate GDV on apartments, i.e. one beds, if there isn't many in your local market? So, I mean, it'd be the same for one beds, two bed studios, but I'm guessing their scenario is specifically one bed. So, Jack, comparable data
Yeah,
for one beds.
I've read this and it just reminded me of our site in Tame. So Tame is a market town in Oxfordshire. We bought a 17,000 square foot office building. It's like the biggest office building in Tame, and there's no other PD schemes in the centre of Tame, permitted development schemes to convert to flats. So our comparable database was non-existent. There's old cottages, there's houses, because it's a quaint market town. We just really struggled to get comparable data for flats. Within Tame. It's quite a big town. I think it's probably 20,000-30,000 population. And it was just super difficult. I would pre-warn 5K, 3TY that the biggest risk is actually your valuer from your bank to buy the site, because they need to get an understanding of what the site's going to trade at the tail end. So you might have a gut feel and you might have a good good experience and knowledge in the area to put your own value on it and back yourself. But the bank underwriter and valuer have got to sort of align. So what we did with that site is we, believe it or not, and this is kind of like a bit of a tip on actually how you do risk it for yourself, I wasn't that confident about the values. The agent was pushing that the GDV values would be about 500 a square foot. I thought they'd be more like 425, 450. So what I did is I made my offer conditional on getting comfort around the gross development value with local agents. I then went to 10 local agents with the schedule and got values off all 10 of them. Agents tend to be optimists, one, to win business, and two, because they're a salesman. So you can normally soften the average of those values by maybe 5%, and also put your own view on those. What I would then do is send all of the best valuations, the top three, to the valuer, because he's going to be pessimistic anyway, and you need to make sure the valuer values up the site on acquisition. But to get to the values, I would take an average of the agents. Reason being, there isn't data, so you're going to have to rely off experience, and their opinion of the local market is more valuable than anyone else's. As part of those 8 agents, I'd get 2 that are not just local agents, i.e. maybe semi-national. For example, the site in Tame, we got a valuation done by Savills. Their internal resource team are really well put together, and they don't want to put the name on something unless they think it's accurate. And that is how we valued it. And we actually ended up at 440 a square foot and chipped the price because it was £60 a square foot less than what we thought we would bid on it. So we de-risked it with the buy. We managed to narrow down the figures. I don't tend to work so much so with agents on the outset. Normally I get a blended pound per square foot just to do a draft review, and then when the deal starts to look a bit better, I will do my own sold comparables research on Rightmove. So if you go on Rightmove, put in the postcode on sold comparables, find like properties, make comments if the garden's bigger and this, that and the other, amenity space, parking, location, and actually go through and get a feel for the market and think, if I had 200 grand, what would it buy me? And that's how you narrow down your valuation for something, especially if there's no local market data.
Banging. Ronan?
I think I'd keep it quite simple. Like, absolutely what JJ said. I just add as well that, you can probably get a view of what existing one beds are costing in the area. And then obviously there's a premium for a new build, or if you've retrofitted something. So you can get a pretty good guide off that. And if you're too aggressive on your number, you could have people come in and look at the property. Sorry, you could advertise it, and see what kind of levels it's getting at. But there's many ways to look at a one bed apartment in isolation and try and get a value on it. And you also could go to a neighbouring town, similar setup. Yes. Fine, it may not be in the exact town you're in, but you can get a guide from that, especially if it's a retrofit or especially if it's a new build. So I would say just look around and use some of them parameters, get assistance from an auctioneer or estate agent, but you should be able to do it yourself. I don't really think you need an estate agent to give you those figures. You should be able to research and do it yourself.
Yeah. Big D.
So the majority of work for us, our sales are forward sold, and you can do that in many different strategies, whether it's social housing, affordable housing, PRS, commercial, forward sold, pre-let commercial, later living. There's lots of different industries where you can forward sell. So I'm going to take this. I agree with both Jack's and Ronan's response on open market, etc. But from that angle, if you're looking to forward sell, then it's all about client and is all about customer led. So whatever your strategy is looking to do in that environment, find your customers, build a relationship with them, get on the phone with them, send them a hypothetical deal or a real deal, and ask them questions. And literally, depending on you need a bit of emotional intelligence to be able to read the room and read the person. Some people you can just literally, which I have done, ask them, how do you calculate the value that you can pay for this apartment? And they might say, we link it to market value, we link it to market value with a discount, we have a yield target of X, it's a land and a build price, and it's got to be value for money, and that's calculated with a RICS value for the land and a QS report for the build cost. There's lots of different ways like that, but ultimately it's client led. So find your clients, build a good relationship with them, and after the first to and throws with questions, you should be able to work out how their appraisal works for their own viability, and then you can take that methodology crudely and then put it into your own appraisal when you start looking at deals. Does that make sense?
Yeah,
Dorian,
banging, mate.
just a quick question on that. When you're forward selling your deals, is your red book value based assumingly on today's value? And if that's the case, can you put not fluctuation clauses, can you put, say, look, interest rates or whatever? So what am I trying to say? If our expectation or the forecast is the prices are going to rise by 3.5% or 4% in the next 8 months or 12 months, can you put that into your agreements, or is it on red book only of today's value?
Yeah, sure. So there's lots of different structures. Like if you're going to do a mixed tenure development with a partner, you could look to structure on a JV basis with them, where they would still buy the land and fund the build, and you would do the build at an agreed OH&P, and then there'd be an uplift basically. So if the prices do go up, you would share in the uplift. So you're safeguarded that way. If you wasn't doing that and it was just a standardized fixed price deal to build it out for them, then you wouldn't get a benefit in the appreciation, but ultimately your build margin would be higher than the OHP you would have in the JV structure, and is a bit more certain. Obviously, you'd try to get fluctuation provisions in there in case build cost inflation goes up to safeguard that bit. But other than that, the only other way really is also if you're looking to do a deal and it's like affordable, so it's a discount to market value, is that requires negotiation, because every different partner will have a different way of how they calculate an open market value. You're going to want to try to, to and throw, get the best discount you can. And it just comes down to that. So there's no easy answer really. This whole industry is just constant negotiation.
Yeah.
Nuanced, yeah. Well, the only thing I'd add, that if you're doing something desktop, then what Ronan said, where you go to a neighbouring town that's a similar sort of town. So you don't want to go to a major city nearby. You want to go to a similar, whether it's like a secondary or tertiary sort of town to a major city. Then you want to make sure you're in a similar type of town, and that you're also not on that you're comparing similar micro locations within those towns. I.e., if your property specifically is in a seaside town, but it's on the other side of town to the seaside, then you don't want to go to another seaside town locally and compare to a seaside site or a seaside property, because there could be uplifts on micro locations within a town as well as macro. But I think you can I've seen valuers on our reports use other towns within the region as comparable data where there's not as much stock up here in the northeast for apartments. And that can work. But as Jack said, you get 3 local agents, they've got the experience, you're buying their 10, 20, 30 years of experience in that area times by 3. So it's probably the best way to deal with it.
I would say be super careful with that, because we've got properties, for an example, in Abingdon on a road called Edward Street, and Edward Street abuts with one road, so it's like a T junction. And if you're on this road, the road we're not on, we've got 3 houses on Edward Street, and if you're on this road, the pound per square foot value is about 550, 575, because it overlooks green, and we've been buying at 220, 250 on this road. So I would say you've got to be super careful, and only local agents are going to know that. You're not going to be able to look at another town and go, right, well, it's 300 net in this town. And so for another example, our site in Tame, we came in at 440-ish a square foot. Our site in Princess Risborough, in literally 8 minutes drive up the road, very, very similar town, very similar rural location, but we're exiting at like 550, 575 a square foot. That's your profit margin if you get that wrong.
Well, do you know what? I think that actually highlights something, that there is a big disparity between the north and the south. Like in the north, don't get me wrong, there are streets where there is a significant uplift in value, but generally speaking, your average values are pretty predictable within towns, unless you are, doing some sort of niche offering. Whereas in the south, I've seen it in places like London and Shepherd's Bush. You could be on one side of Goldhawk Road or the other side, and if you're on the other side where you've then got Hammersmith Grove, then fucking hell, your values can double per square foot. So yeah, I mean, in the south or in specific locations where there are high values, there could be a big swing. But I think for desktops, you can get a relatively good idea by using some comparable data. But if you're going to go in and secure something at offer, then yeah, you need some concise information from an agent. But go on, next question. Yazin Magd D14 asked, best method to find good deals. D, I know you've got to go soon, so we'll start with you, D. Yeah, and luck. Luck at the Irish.
Yeah. Apologies. I have to shoot after this one. But so again, it'd be interesting if we all try to answer this without our current kind of knowledge and it's not that, but our current level of I suppose reputation to get deals, because I'm pretty sure all of us now get a lot of deals coming through from agents and introducers, and I think we could all agree that they are in terms of the best quality deals that come through, highest chance to progress with, less competition, and anyway. But to start off with, when a new, if a new entrant came into our market and they were up against us, then how could they find good deals? And ultimately, you have to kind of prove your stripes, win your stripes in a way. And so when we started out, I was trying to find deals anywhere. Gumtree, classified ads, Rightmove, agents as well, introducers, putting posts out saying obviously we'll pay referral fees. I've done things like signs, billboards, and then of course the actual scraping planning, the planning portal from my criteria, using a software like Landstack or Nimbus or Land Insight or Searchland, and then sending letters out. So it's a combination of things really, but ultimately the goal is to put a lot of effort in constantly, track where all your leads are coming from, and eventually just keep getting your name out there where introducers start sending you deals.
Yeah, and what would you say, D, as a part? Because obviously you're sourcing a lot of deals and big deals as well, and land, and there's a lot to look at. What would you say? Big deals, baby. What would you say is the if you had to put a percentage on it with the type of avenues of marketing where these sites are coming through? What sort of percentage would you give to that, from introducers to your own guys going to find it, from marketing efforts?
Well, so now, which is our biggest goal, which we're really happy about, 4% of our leads in the last couple of months has come from clients, so housing associations, which is really where we wanted to be. So becoming known as that specialist, and the clients themselves bringing you deals. Once you start getting that, then you know that you're becoming known for that niche. Really, 65% of all of our deals have come from agents off market, and then another 15% have come from introducers, and then 4% of them from housing associations or just clients, and then the rest is a mix of pretty much direct to vendor letters, us with our own active efforts trying to find deals.
How does it work then? If the housing association brings you the deal, can you then sell it to them? How does that work in that scenario?
So they'll only ever bring it forward as a lead. It's a lead. And it might have a complexity on it that we can do. Like,
so they don't
we can
own
do
it.
things like golden brick deals. So some housing associations can't claim back to back. No, they won't. They don't own it.
I can see how Ryan's brain was working. So you bring me the deal, I then sell it to you.
At margin,
build it out for a profit.
It's fucking brilliant. These cracked it, mate. It's like printing money.
It's unbreakable business model.
But on that, there's nothing wrong with going to any of those associations saying, look, where are you looking for product? Where are you looking for housing? So that's enough. Just go off and find the product in those areas. bring it to them.
Well, that comes back down to the last question, which is demand led. So whatever you're trying to do in whatever niche, not necessarily just social housing, but all of the sectors within property development, and there's tons of them. There's going to be clients or buyers, etc., and your job is to find those. For example, like if you could specialize in roadside developments like drive-throughs, and there's a whole list of customers that are looking for sites like that across the country, and you could specialize in that. And there's also funders that specialize in funding it. Or you could specialize in doing office commercial yield compression, but and then basically finding those types of units for those customers, and then but it all comes down to knowing who your client is, getting their criteria, as you said, Ronan, and then but in the early days, until you start getting introducers, you have to put a lot of effort in really and just try lots of different sources. I don't know if anyone disagrees with that.
Yeah, I totally agree. I think at the start, you're just grafting. Like, you're going through the websites, you're looking at loads of deals, like 50, 60 deals. It should be more than that. Um, I think it also depends what you're after. If Yasin is looking for flips or HMOs, then obviously he's looking at the property websites. Look for the worst house on the best street. It's an easy win to go in and do that up and move it on or flip it on or keep it or whatever. If you're looking for actual development sites, like, obviously you've the same similar channels as looking for a property, but you're going to the estate agents. I would be on the phone to the estate agents every week, even if if they don't have a deal. I might say, who's coming to you, what kind of deals are you about to launch, anything like that. We're always chasing the estate agents. There's always loads of deals. I don't like when people say there's not many deals in the market. How many people are you ringing? How many agents are you going to? Whose door are you knocking on? There's always deals. So, like, just be aggressive. You've got to be very aggressive. Get out there. You're probably going to waste 90% of your time doing development analysis on stuff that doesn't come true or you get outbid on. So that's just part and parcel of life. But if you get a strike rate of I don't know what the guys think, but if you got 2 of every 50 deals you look at, you're doing well. I don't think I'd want 15 deals of every 50 because I'm buying them. I'm too aggressive. It's something wrong. So it takes time to find a deal that meets your metrics, is in the right geographic for your operation. Like, there's no point in me getting a site that's
Sorry, gang, I've got
3 hours away.
No worries, mate. Big
I've got
love,
to shoot,
D.
gang. Very sorry. I'm going to go to the
D.
solicitor's office. Fingers crossed we complete on a deal today. But
Send a message later in the group.
Good luck, mate.
Yeah, see you later. Have a good week.
Good luck. Bye-bye. Go on, Ronan.
So like it needs to be obviously in your geographic area. I hunt within about an hour and a half where I operate. I don't at the moment want to hunt beyond that, but sure, as we grow, you may set up a different office in a different location which covers wherever it's hot at the moment. But yeah, that's typically what I do. But I would principally say be aggressive, get out there and look at as many deals as you can handle, 50, 60 deals plus, and meet loads of agents, speak to them all the time, tell them you're ready to buy. But when you do go to buy and you say you'll buy, bloody execute. The worst thing you could do is get these deals, good deals, say you're about to buy them, and then, all of a sudden you stop because it hurts your reputation.
Yeah, big one. Jack?
If there's an issue with the site when you discover it, then of course it's sorry, this
Blame
issue
on
has
the
not
site.
been raised. When you get into the DD, you can still say this deal doesn't work because of this now, which was not part of the initial pitch about it.
Yeah.
So that's also part of it. But yeah, if you've concluded all your DD, everything's good, you're ready to sign, and you're going ahead with a deal, you need to execute.
Yeah.
Yeah, I mean, from my perspective, this is like my bag. This is, I'm bad at a lot of things in our business, but this is definitely like where I find my flow and where I'm most effective in the business. The biggest mistake I see when people trying to find good deals, people always say, if you go to an event, they say, how do you find money? How do you find deals? Once you got those two cracked, a developer's life is a lot easier. But the biggest mistake I see people out there is they get what I call deal distracted. So they let the deals walk. They let the tail wag the dog. They let the deals walk them. For me, I take a very holistic approach, and the deals come and go, but your business strategy does not. It should be concurrent throughout, and it should be in line with your growth of your business. So the first port of call is you've got to understand what deals you need. So that's how big they are, what location they are, as Ronan mentioned. You then need to improve that process to get an efficient way of offering out on those deals. Valuing your own time is more important than valuing each deal. You need to put in the work. We've got out over 1,000 offers in 6 years, which has secured 80 sites and houses. So that's an 8% hit rate. And you need to get those offers out the door. Like Ronan said, I've had people that go, I haven't found a deal yet. And I'm finding out they're offering on 1 deal per month. We offer on 20 deals per some weeks. And that's just the ratio that you've got to go through if you're doing on market stuff. Once you improve the process and you get closer, you've got to create. No deal arrives on your desk with a ribbon around it saying deal. You've got to create every single deal in every single way. That's price, terms, duration, risk, planning, delay completions, whatever it may be. Your job is to create, communicate. Ronan touched on it. Even if the deal is not for you, communicate back to the vendor or the agent why it's not for you. Leave a foot in the door from a potential value that it might work for you, and that feedback either then comes back to you with that deal or drives you a new deal. And then follow up is my most important thing. 90% of our deals have not been secured on the first round of bidding. We've been outbid. They haven't performed in legals. We've snuck in and gone in and bought it. So that's 90% of £80 million worth of pipeline we've delivered in 6 years. So if we didn't do that, we'd only be delivering £8 million worth in the last 6 years. So focus on follow up and just repeat. Stick to the process, trust the process. It will work. They will come. You are more likely to get deals from your follow-up than your new deal pipeline. And that's my view. That's where we spend our time. And that's how we've managed to secure 80 properties and sites.
Our nugget, I would think as well, sometimes it gets overlooked, is you have to have a robust model. And what I mean by model is your development analysis. If I look at 200 units or 60 units in one scheme, that model will take me 15 minutes, 20 minutes. I have a very robust model that can knock out the numbers very, very quickly. And that's a very efficient use of my time when I'm assessing a development. When you're starting off, you're going to have 200 revisions of your model. You're just going to build it, and see what works and what KPIs is coming out of your review of the deal. But it's important to start your model early and keep revising that, keep enhancing it as opposed to revising it, keep enhancing that model so that you know it inside out. And also it's telling you the right numbers when you put in the details of the site, the abnormals of the site, etc., etc. I think that's key as well for both the time and just, seeing does the deal work. That analysis needs to be efficient.
Yeah. I think in answer to Yaz's question, you've obviously had some very good advice there. But it's not just the method of finding the deal; it is the method of the approach, the offer, the structure, how quick you can be.
Appraisal.
The appraisal. There's quite a lot in there that there isn't just if you miss one of those attributes in the process of securing and sourcing deals, then you could be off. You could overpay for something. You could buy the wrong thing with the wrong DD. You could get your numbers wrong, and there's all kinds of things that are involved. But yeah, method to find good deals. Ultimately, it comes down to what you're looking for. If you're looking for HMOs or smaller commercial to resis, there's a lot on the market, but you're competing, so you want to have a good method of approach, a good offer, a lot of follow up. Offer on everything, sub BMV, and just see what comes back. If you're looking for more bespoke land deals and things like that, then Nimbus maps and getting letters out there can be another way of doing it, where you may not have to compete as much with the open market. But yeah, there's a package of finding deals. It's not just finding the deal. There is the appraisal, the follow up, and everything else. So next question from Jimmy Keeb. Said, great video as usual. This is from our last pod, I think it was. Next time, it would be fantastic if you could share a video about your property horror stories. Talk about what went wrong, what it cost you, and the lessons you learned from those experiences. Funny you say that, because we spoke internally about a week or two ago that we wanted to do a podcast at some point where we just case study a deal, either a deal that went south or a deal that done well, and all of us would go through it individually. So
how about we talk about horror stories outside of a deal? The first one that came to my head is a deal. Horror stories.
I can give Jimmy a quick one. Inflation hit me for about 700 grand on one of my previous deals. So when you have all your cash in the deal and your bank and your senior debt lined up, obviously they're doing about 70% of the debt, and you're putting in 30, and then inflation rockets up to between about 12 to 15%. They put a 700,000 cash requirement on a deal. So there's plenty of stories, and I suppose horror might be the wrong one. They're all keep you up at night. Well, some of them certainly do, and it's just about trying to manage that. Um, but God, there's loads. There's loads. I don't think there's ever quite a straight deal, and certainly you won't learn off a straight deal. If it's too easy, it's probably, you've got lucky or something. But yeah, you only learn off the difficult deals. What do you think about investing in social housing? And is it a good idea? I think it's a brilliant idea if you have the model to do it, because at the end of the day, your exit is essentially lined up. So if you buy a land deal with X amount of houses on it or X amount of apartments on it, before you start, you have agreed a contract typically for social housing, whether they're buying it or leasing it. So then when you go to the banks, it's very easy to finance that deal. Debt is essentially very easy. Whether, let's say it's a deal with the government, it's essentially like a government bond. It's then just up to getting your equity players together in order to conclude the deal and get on with it. So I actually do quite a lot of social deals, from contracts from say 20 units up to 200 units. In this moment in time, they're great. They're plentiful at the moment in Ireland. Prior to that, you're doing your traditional show houses and things like that, and that's probably the norm. But at the moment, there's such a need that the governments are jumping in and buying this stuff forward, which is great, especially for young developers, because um, it takes that element out in respect of closing the sales at the end.
Yeah, so I obviously have a slightly different model from a social housing perspective. So we repurpose existing buildings, so it's not new build like Ronan's touched on there, and the government won't buy our stock, unfortunately, because it's repurposed used stock. So the most important things for social housing, we have a private HMO portfolio, coincidentally, over 100 beds, and our social housing portfolio is actually a similar size. I personally prefer my private portfolio. There's a little bit more control. You're only as vulnerable as potentially one tenant in a whole portfolio, whereas with social housing, you're as vulnerable as the tenant. If the tenant is causing issues and they're across your whole asset base, that can cause problems, which we felt. We've had to do a deed of surrender with a prerequisite housing association that weren't performing the management for the end client, which was a difficult manoeuvre because we had best part of 80 grand's worth a month of mortgage costs. And when you're not sure when they're going to be paying rents on time, that's pretty daunting. So I'd go through the most important things for what we do, which is lease-based. So we repurpose buildings, lease-based social housing. The covenant and the management of the covenant is really, really important, and the sustainability of them taking on your assets. There's a bit, every man and their dog jumped into social housing over the last few years because there's good money to be made in it. But what we've always focused on is the sustainability of the product. Now, what that means is look at your room rates, look at their operational costs, and look at the margin that they're making. Because if they're not making money, you're not building a sustainable portfolio. Make sure the lease is good. That's a really important thing. The funding, acquisitions, and refinance is super important to understand before you go into it. The planning is super important to go into it. We've got C1, so we've got C2, C3B, C4, sui generis, all the different use classes we've got across our portfolio. And then exit. If your exit is protected, you're all good. The beauty of social housing for what we do is you've got a commercial lease in a residential property. So you're signing a 10, 15, 20, 25-year lease, full repairing, hand it over to the Registered Housing Association, and they take care of the asset. The problem that I've outlined is when their operational or feasibility of running that is not good, it backfires because you can't sue someone that's gone under. So we've had to port already, and we're already having problems with our new HA, and it's a bit of the Wild West out there. In reality, there's actually, if you want to go down a bit of a rabbit hole on social housing, Google the Home REIT scandal and where they're at and why they're folding up. But Home REIT were actually the biggest real estate investment trust and social housing provider in the UK, from a landlord perspective, and the care wasn't there. So they were drawing all of this enhanced allowance, but the care wasn't there for the end tenant. And what you get is this unsustainable cycle, which eventually goes pop. Some of these properties weren't even occupied; they're empty. So it's definitely something to look at because it's how you do it wrong. And if you're going to do any business idea, make sure you know how to do it right and how to do it wrong as well. So it's definitely worth you reading up on Home REIT.
the good part of that as well for your side on the social housing, JJ, is that if you ever wanted to sell that product or that property, I'm assuming it's of higher value because it's in a social lease. So your yield or what an investor will pay for it is higher because essentially it's with a government commercial lease.
Yeah,
Your yield is higher, right? I guess, yeah.
yeah. So how we as a landlord make money on social housing is we've essentially built a HMO portfolio that has a lease with a registered housing association. Where we make our margin is we're buying bricks and mortar assets, we're getting a lease signed. The yield based valuation for that particular asset might not be that different to bricks and mortar valuation. But when you compress all of the assets in a higher value, so we have £22 million worth of assets, and you compress them all together so someone can buy them as a portfolio, the yield comes down, so you get a better price for the portfolio, and then you can compete with better buyers like pension funds, family
What's
offices.
the annual revenue on that portfolio?
So our net income is 1.1 million. So our portfolio is probably currently sitting at about 6.75%. Believe it or not, we actually were due to sell our portfolio at 5.5% net internal yield just before Home REIT and Liz Truss completely carte blanche the market. So crazily, the market has moved. It actually moved up to like 7.75 within like 3 months. Biggest shift I've seen in commercial yield valuations in
If you
my
don't
time.
know if you don't know the difference of what 0.5% makes in yields, like it's crazy when you look at a 10 million or 20 million deal. The difference
Yeah.
of 5.5% yield to a 6% yield to a 7% yield is
Oh, so
absolutely
so to put
chalk and
yeah
cheese in terms of
to,
costs.
to put that in context, the portfolio was worth because there was a couple of assets that we hadn't finished about 20 million quid at 5.5% net internal yield. That change in 3 months took that portfolio down to about 15 million in value.
It's incredible, right?
And
One
now
and a
we're
half 1.5% difference.
correct, and now we're pushing and softening up to about 6.5. So that same portfolio is probably about 18.5, but we've
Yeah,
added assets to it, so we're now at 22.
sure.
But yeah,
Mad, isn't
huge
it?
shift and quick shift, and the
It's
commercial
just,
market is still feeling that. We're
but
still
it's a
still recovering.
percentage in that percentage of compression is exponential, isn't it? Because although it's a percentage difference on the compression, it's what 25% decrease in value, which is
And nothing, the
significant.
product hasn't changed, you know. The product back then and now is exactly the same. It's just the interest rates are up.
Yeah, yeah.
Something that's outside of your control. So like for young guys or guys starting out looking at this, like you have to be you have to have a knowledge of what yields and how they're affected by certain things such as interest rates. It's
Yeah.
massive to JJ's example there in his portfolio.
Absolutely. And just in answer to the last question, because my internet was bugging out. I think it's because I had a shared Google sheet on and it was drawing a lot of internet or something. But horror story, same thing as Ronan. Inflation cost us about 400 grand on a site, and that was an absolute cock. So inflation is inflation is not your friend when you're getting into the construction aspect. It is your friend when you're holding assets and it's sort of paying off your debt in a nice cheap way, but it's not your friend when you are buying lots of materials at quantum. And as for social housing, I'm not big on social housing. Morally, I don't quite agree with it. I think it builds out a socialist culture in our country that should be entrepreneurial and free market and private sector. But that is my personal opinion on social housing. There is money to be made, but most of the market is filled with cowboys, as Jack's sort of alluded to. There's a lot of government money sloshing around. There's a lot of dodgy characters I've stumbled into in that market, mostly from the providers' end. The developers generally are just looking at a way to, diversify and make returns on their assets. But some of these providers, mate, fuck me. There is
Yeah, so one thing to be really cautious of is we've met with providers and landlords, and the finger always gets pointed at the landlords for being the greasy ones, but it's not us. It's where the biggest set of cowboy-ish activities is a landlord goes into the sector, realizes that a registration behind a housing association is really difficult to get. You might spend over a decade to be a registered housing association. That's where the golden goose lease is. That's where your yield compression goes greater, because if you're registered, that you're obviously registered by a government body, and also if you go pop, the regulator helps pull other entities in to recover all of that social housing stock, like a utilities company would, for an example.
Yeah.
As soon as potential sharks in the market catch wind that that's value, they try and take over the RP and become the RP and the landlord, so they have two bites of the cherry and they have more control of what's going on. So if you are potentially looking to fill your building with a social housing tenant, and they turn up in an Aston Martin and stink of some form of aftershave and have slick back hair, then they're probably not a charity. They're probably doing it for other reasons. And bless the charities out there, is difficult for them to, it's super difficult managing a regulator. From what I've seen, we've actually had to roll our sleeves up and help our HA at the moment.
I think Panorama did a good piece on a provider in the UK. I can't remember what it's called, but if you type in social housing Panorama documentary piece, and they go into one of these guys, and fuck me, they were just rinsing investors left, right, and centre. These tenants were getting left with an awful service. Like, the money that gets extracted from that side of the property sector is insane. And then that's why I hate this white label on top of it. That's like, it's for social good, with housing people that need it. When really the guys behind the scene are just fucking raking in the cash and exploiting every avenue.
We have a situation here in Ireland where you have a lot of international protection, people coming in from displaced countries or countries at war. And there's people actually taking the piss in terms of housing them. They're, putting a lot of people into the one house, or maybe have converted literally a barn into a temporary accommodation where the government's paying massive costs per head. Is that happening in the UK?
Yeah. The hotels are getting filled up and all kinds of bollocks. It's nuts.
I don't think we're filling barns. So
maybe not barns. Yeah.
But yeah, I mean, it is happening. Obviously, our net migration is out of kilter for the housing that's supported. Do you know an interesting fact that a asylum seeker would get housed 4 times over before a war veteran in the UK would get housed?
Disgusting.
So the general the way that we handle all of the asylum seeker migration, obviously they need a place to stay, but we actually, Ronan, taxpayer pays a huge amount of money for hotel stays, and the social housing is at kilter too, because our social housing can't keep up with the required social housing or even homelessness. So it goes into hotels, and a huge burden on taxpayers' money, which actually the Labour government are actually looking to improve, which is interesting.
It's wrong. Like, what we've seen hotel rooms, which would have, let's say, traditionally a person or 2 people in it, they're being charged out now at €70 per person in the room. That's a minimum of 4 people in the room per night, 300 every day of the year.
It's because the government gets involved. That's what I hate about social housing. When the government gets involved in a free market, especially the property market.
Is slightly different. Like international protection and asylum seeking, it's a different ballgame.
No, because it skews values. Like, it skews values. I think it just, wherever the government get involved in any sector, they destroy the free market, and they skew incentives, they skew values, they disrupt the natural competition that we need to retain values and keep a supply and demand flow that's more predictable. They get involved and they offer up money somewhere. They can distort land values straight away, which then hurts the private sector and private housing. And then we wonder why housing is going up, and the demand for hotels. Like, we need commuters, we need business people traveling around the country. If they're all filled with asylum seekers, where are they going to stay? Now people are turning Airbnbs around, and then they're charging more for that, and it just distorts everything.
Help to Buy is coming back to the UK, right?
Hopefully, yeah. There's two forms. I mean, they're looking to support Help to Buy and also up stamp duty for international acquisitions to support more local.
I do kind of rate that.
Oh yeah. I do rate that. I think Dorian touched on our last session. Like, if you just sort out the planning process, more housing comes into the market, prices soften, more people can be housed, more people can afford housing, rents start to drop. That just sort out the root of the problem rather than trying to sort out the retrospective problem.
Zoned land. It's the origination problem.
Yeah,
absolutely. All right, next question.
A little rabbit hole on.
Yeah, a little social rabbit hole there, boys. Harry Hursty, thank you for your question. Do you use the same consultant team for your projects?
I might take this one first.
Go on,
simple answer is yes on my part. for good or bad, I have the same architect, engineer, mechanical, electrical, and fire guys for all my projects at currently. I think it's works for me because it's more linear. We can have a progress meeting on, say, a Tuesday and cover 4 or 5 sites in that progress meeting rather than having 4 sets of different meetings with emails going out or minutes going out against all of them. It just seems to be a better use. Now, there's downfalls with that in that if a particular consultant is strong on one thing but weak on the other, then you're pulling them along. But there's great synergy between the teams because everybody knows what they do and everybody knows each other quite well, or especially when they're under my umbrella projects. So for me, that works. And the other thing you might get is you get probably a better rate in terms of your consultant costs because you bring them into so many deals now. So yeah, that's what I do.
Yeah. Big J?
Yeah, we don't have construction in house, so we tender every project and we bring the consultants in for every project. Not all of our projects are in exactly the same locations. As an example, our project in North London, we're retrospectively digging a basement under an existing building, which is quite complex. So we might have a slightly different structural engineer for that job, as opposed to another where we're banging in 3 steels and we don't want to pay good whack for the same structural engineer. So we do pivot and use different consultants. They're more sort of adapted to the scheme, but we kind of have a bank of 3 of each. So planning consultants. Obviously, we tend to use Aura architecture for all of our projects. Even if I do a house, I probably won't use Aura because it's too small for them. So we have like a bank of 2 to 3 consultants that we work with routinely. We're fortunate we're busy enough to always keep a few people busy, and we sort of pick and choose who goes to what project at what time. And it's good to always, in my opinion, keep everyone honest and tender things out because then pricing's correct. They're working hard for it. They know that they could lose that business at any given time, but you're fostering a good working relationship. Like Ronan says, they know how you work. They know how to sort of operate alongside you. So kind of what Ronan said, but slightly a few consultants that we bring in on various different projects.
Yeah, I'd say if you're starting out, don't settle for the first guys you use on the first project. Even if you've had an
Oh,
amazing
absolutely.
experience, then yeah,
Absolutely.
give them the benefit of the doubt. But it's when we started, I tried out 4 or 5 different architects, 2 or 3 different planning consultants. We went for a lot of structural engineers to find the guy we've got now. I find it quite hard to find a reliable and very good structural engineer because the good ones get really busy and go onto big sites and end up fucking off. Architects, you can find a lot of architects, but they can be. There's so many variables with an architect. It depends
Yeah.
how good you are at the design. If you're good internally as a developer at design and space, and you can visualize these buildings and think of the different requirements, then you should be able to get the most out of even an average architect. But yeah, I'd say trial different ones initially. And once you found that good team, that consistency of knowing that you can trust in their competence, they know what you like, and they know what your standards are, then it gets a lot easier on future deals. You can save yourself months of delays and conversations and bollocks if you've got consultants that know you. That's probably all I'd say about that one. But yeah, you should always be tendering. We probably don't do that enough as a business. We probably should be tendering some of the consultants a bit more. We sort of just rely that we've got them there now, worked with them for years, give them the work, but prices can creep up on you if you do that. So not the best idea. Matt Blackhall has asked a question. Thank you, Matt, for your question. Do you just go for the cheapest option on insurance, buildings insurance, 10-year warranties? So buildings insurance and then warranties. What would you say, guys? Ronan?
I generally get the broker to give me advice on it. So like if you are paying a broker, which I do, like they kind of give you the best deals and what it includes, what it doesn't include. They also can look at the particular project. So I'm doing one project now in Dublin, which will have a GDV of about 22, 23 million. And we're taking out a project specific insurance for that. So that'll cover every subby on site. And it ring fences the risks on it. Where traditionally I would have my insurances cover, my limited company, and it would cover the other companies underneath that. So my advice on it is use a broker. It's a small fee for when something goes wrong that certain things are covered. Cheapest, again, it's kind of a loaded question. The cheapest could be missing certain things that you kind of need protection on. You could need, do you have directors protection in case you make the wrong decision, things like that if you have investors. So, my advice would be to use a broker.
Yeah. Jay?
Yeah, I'm very similar. Obviously, a broker's there doing it day in, day out. What we kind of touched it. We've worked with our insurance broker for literally like 8 years, and I know that he would feel so responsible for making the wrong advice or putting the wrong policy in place that might come back and bite us. So make sure that that broker actually cares about your future business and you and your business. But yeah, we when it's site insurance, so buildings insurance, we tend to just go with the cheapest that's got all the standard covers, because at the end of the day, it's a very unlikely black swan event where you have an earthquake or a thunderstorm or a flood. So from buildings insurance, we try and make sure that that's as cost effective as possible, and we always put it on monthly direct debits because then you can cancel it anytime. We don't pay the premium up front, which saves a load of aggro. We've had it before where some of our sites are like 10 grand for insurance for the year. And if you've got to pay that up front and you then exit the site within 9 months, you then got to claw back 3 grand's worth of bills. And it's just a pain in the ass.
Yeah.
So I'd rather pay a small premium of 6% and pay it per month. And as far as warranties and buildings insurance warranties go, I would just think about the end buyer in mind. You want to make sure that your exit is as smooth as possible. And if a buyer's got questions about who your covers with, we've actually seen warranty providers go bust within the term of the sale. So you sold a property 2 years ago, but you've got a 10-year warranty with a provider that's gone under, and the buyer comes back to you, and that just gets super messy. So make sure your broker understands that if you are getting a warranty on a building, that they have a good balance sheet, they have a good P&L and profile, and they're a well-backed entity that have good cash flow reserves and so on and so forth that are run correctly. Because the last thing you want is to get a 10-year warranty and it actually is a 2-year warranty, and then they go bust, and then it's your problem to deal with that particular buyer, or even if you've kept the stock for obvious reasons. So lean on your broker. They do it day in, day out, but that's a fair question.
Yeah, broker. Yeah, I mean, just maybe to go a tiny bit deeper on the buildings insurance side, you've got your standard FLIA cover you should always get, and then you got your excess, and then your reinstatement value. So your excess is where you can wiggle that premium as well, depending on your appetite, and then the reinstatement value. Now, there's been times where we've bought a building and got the insurance for the value of the purchase, in specific scenarios, but generally speaking, your reinstatement value is going to be higher than your purchase, depending on what you're buying. If you're buying a building that's there in situ, if it did burn down and you had to clear the site, demolish, and build it back up again, it's going to cost you more than what you bought it for in most scenarios.
Not down
Especially
south.
not down south, up in the north, it definitely will. And again, these are the things you'll need to know. We find as well that when it comes to the reinstatement value depicted by the valuation, especially in the north, we can be buying properties and getting an end valuation of say 300 grand. The reinstatement value is fucking 500 grand. And once you get into the mortgage, you're going to have to note the interest of your mortgage, of your lender, on the insurance, which will be depicted by the reinstatement value from the valuer. So you just got to know a few of those things. As for the warranty, are you getting a structural warranty or a PCC? Big difference in cost. Depends on what you're doing with the building. We do a lot of retrofits, so usually PCCs are fine, and we can save about 30% against the structural warranty. But Jack makes a very good point. Who is the provider? However, Jack, what I would say to that, if the warranty provider did go bust, is it not likely that another provider would come in and buy up that portfolio, or buy up the interest?
Yeah, not always.
Yeah, fair.
I mean, if you think
Reeds-
about it, it's like there is no purpose to buy a failing insurance warranty business, because the premium has already been spent and squandered, and they're in the red, but the liability is still there. It's taking liability without the upside. There is insurance companies that people buy, like Howdens have bought A Plan. There was a merger where Howdens Financial bought A Plan, but that is buying a business where obviously it works, that their financial modelling works. But if an insurance company goes bust, it's very unlikely that someone's going to be buying it, because they're just all they're getting is liability, no upside.
Yeah, but usually
One,
that's where pressure can come from central government, kind of, and government funding can come in to be the backstop
yeah.
of, depending on how
Yeah,
big the
yeah.
firm is. Yeah,
Government can sometimes bail out if there's going to
yeah,
be a lot of consumer distress. Government can step in for
yeah.
sure. You actually, Ryan, touched on a really good point there of reinstatement value. So for listeners out there, reinstatement value is the value that if the building were to burn down or collapse, that the insurance has got a provision of a cost to rebuild the building. What we found is the insurance needs to cover the amount that the valuer from the bank has said it's going to cost to reinstate the building. But what I would stress is make sure that that reinstatement value in the valuation is correct, because we've had buildings where they've said it will cost like 3 million to rebuild a building that we know that we could do it for 1.8 million quid. And that
Yeah.
difference in cost in reality, so let's assume this scenario happens and your building burns down and you need to go to insurance to get 1.8 million quid. They're not going to give you another 1.2 million quid because you don't need it. So renegotiate that down so that your premium comes down. And that's a really good point that Rye brought up there.
Our reinstatement
Yeah.
value is about 25-30% of the cost of the, let's say if you bought the house. So it's similar to JJ's region. It would be a percentage of the actual cost, as opposed to in the north, you're saying it's above the purchasing price.
Usually always above, yeah, and above the valuation on the back end. Usually always in the north. So
What's your
what
two beds costing? About 80 grand or 100 grand or something, is it?
average
now.
purchase price is now about 100 grand, but we do buy a lot of stuff for 150, 180, sometimes 120, but then sometimes there's 60 grands and 70 grands.
Yeah.
It's usually
And
the
then
end
of
val
course
though. That's the
you probably have to rebuild it with the new standards. So you've new fire requirements, new
yeah.
et cetera, insulation.
Yeah.
So it's totally different to build. Yeah.
Yeah. So in the north of the UK, just for anyone listening, your reinstatement value, if you're building a high gearing asset like apartment building or HMO, maybe the standard resi might be all right. But where there's a lot of infrastructure in the building and you're getting that, and you're upping the value of the square foot. Generally speaking, your reinstatement value is usually 20% above your actual GDV. Which don't be shocked when you see it. It's just a
That's
number.
on existing, but on new build, I guess it's still going to be less.
Yeah, I'm not sure with new build. To be fair, we don't do new builds. So
It has to be. You've no site cost. You've no
yeah.
VAT. You've market cost. So it's going to be 25-30% on new build, but certainly on older ones, yeah, it's as you say,
Yeah.
20% above it.
Yeah, I'm not sure new build. But yeah, hopefully that helps. Matt, next question. All right, so this was a triple question that came in from
Fire.
Amy. See if we can tackle these one at a time. So Amy Sharma, thank you for your question. So there was far more. Right, let's have a go. So there was far more involved than I thought. How did you create systems to foresee this, to get planning? And I've been sat in a bridging loan for that period. Doing my right. Sorry, I've read it back to front. Amy Sharma has asked, doing my first development through owning a commercial building, it's taken 2.5 years to get planning, and I've been sat in a bridging loan for that period. There was far more involvement than I thought. How did you create systems to foresee this? So, i.e., the unpredictability of planning. You sat on a bridge. You don't fucking know these abnormalities that can happen in the bureaucratic side of development. How can you foresee it? How can you plan for it? When going into a project.
I don't think there is a system. I think you have to be aware of your timelines. There is no system, especially in the UK, where your timelines could be 2 years, could be 4 years, could be 1 year. You have to be able in your cash flow to have a worst case scenario and still be able to keep it afloat. So your bridging loan is going to be expensive, I gather. And then does the risk worth the reward? And whatever planning you're going to, how much does it maximize the site? Can you immediately take the site out into a traditional loan once you get planning approved?
Yeah, I'd say I think you touched on the key question there. In terms of a system to foresee these things, experience will just come, and you got to be. I mean, and I'm sure Jack will touch on this. Adding the months on what's estimated and stuff. But there is the other thing is how you buy the site. Can you de-risk your exposure? Can you buy it on an option instead, so you don't have to take out the bridge? And if you can't buy it on an option, maybe you just wait until you can find a site that you can buy on an option. Depends on your risk appetite. So I think risk appetite has to be something you consider, especially if you don't have the necessary experience. So if you've got the experience like Dorian, he's dealing with 2-3 year planning applications. So he just knows by default it's going to take him 2-3 years to get through planning. So by default, he's trying to de-risk his purchase strategy, get them on options, etc., etc. That
A
is
de-risk
about
A de-risk, sorry, and just this commercial building as an example. Like if it's already rented or by someone or leased by someone, obviously you leave them there to pay the bridging loan until such time as you
Yeah.
get the planning. So you look at the deal in the context of it, but in that case, you would obviously leave the person in their lease until you get your planning to cover the interest costs.
If it's leased, and if it's not leased, then you're exposed
Yeah,
to
that's a risk
rates.
factor, you know.
Yeah, exactly. Yeah, it's all risk. It's basically with the bureaucratic side of trying to predict what's going to happen with getting planning or getting financing and things like that, and the bits involved. Can you de-risk it with your purchase strategy first? Is probably the only system I think you can build in. Everything else is, down to how long the council take. But Jack, what would you say? Some advice here.
Yeah, I mean, completely. It's how you structure it. If you have a site we're on site at the moment, which is a conversion of a grade 2 listed building to 8 luxury flats in the centre of Marlow. I was concerned about the planning because it's a listed building. It was occupied with a children's dance school. It was in the centre of town, and I knew that the planning would be a ball ache. So the way I structured it, it was a conditional contract exchanged with 5 grand, which was 0.001% of the purchase price. I then agreed that I'd buy the site subject to planning. I paid a little bit more for the site. I'm talking like 20 grand, but it took 18 months to get the consent. And if I bought that site for 1.1 million quid and carried bridge debt on that position, it'd have probably been 200 grand down the hole. But and business rates, and the tenant ended up not paying any income. Then you've got utilities, so you've got all of these costs that we'd be racking up on that site. So we agreed a conditional contract. So what I would say is, if you don't think that planning is going to be a breeze, push the time liability onto the seller and give them a little bit more money, and it de-risks it from you from the outset. If there's
Something
plenty of
to
headroom, in the deal, i.e., 3 years worth of bridge carry costs until you get to that. So let's say that 1.1 million, the seller just wanted to get the deal done, and I agreed 800k, I would still be in a better position come 2 years time. So if there's plenty of headroom, you can go on con if you're confident. And the only other thing I would say is just do more deals. Like if you're sat there waiting for one deal, watching costs go down and planning take forever, it is demotivating. I was with a consultant on Wednesday night who came to our event, and he said, "Well done on your planning application yesterday." I didn't even know what planning application he was on about because we've got about 10 in at the moment.
Yeah.
And when you're doing multiple deals and not trying to bring a deal in today and thinking about just building your pipeline, like it's like a forever, ever growing, evergreen space for you to constantly be working on projects and nursing them forward. I kind of don't care when we get on a site. We just work through the process. So do more deals is one thing I'd say. It sounds like this particular deal has been a thorn in the side, and you do get that. You do get deals that you can't see things that you thought would happen and plan out from the beginning. You might have thought something was guaranteed in planning and it wasn't. So you make sure you've got the right team around you to make sure that you're not catching a cold on one site that then impacts everything else. We always talk about the house of cards. So do enough deals. If one goes wrong, it doesn't impact the business. And that's how we outlook on things.
Yeah, lovely. So hopefully that helps. And I've just realised it's not Amy, because this is definitely I think it's a bloke in that photo. If not, I've really insulted you, but I think it's Amy. I think it's Amy, not Amy. So sorry, Amy. Next question. This is from 17 Hugao. How do you price for the development work? Do you mean construction work or development work? I mean, if it's development work, then there's a myriad of things that you need to look at. If it's construction work, then that's a bit more simple. So maybe we look at this as development work. You've got the different pieces in the pie here. Ronan, what would you say, mate?
How do you price for your development work?
Let's say this is when you're doing a desktop appraisal. Let's say desktop appraisal before surveys.
I generally know what it costs per square foot to build it, and there'll be a margin in that, a safety margin. So I essentially use the square foot, and put a rate against it. Then for infrastructure, similarly, I would have a cost per linear meter to put in a certain infrastructure. You put those together, you look at the planning mix, or the mix you're getting on the site, and you basically add up the square foot and then put those in. You'd also be adding what we have in Ireland called contributions. You've obviously have to add your site costs. You have to add consultancy costs. There's a range of items that you've to price for there. But in terms of the actual construction cost, it's based on a square foot rate.
What about the development costs? So soft costs, your financing costs?
It's a percentage. So, for example, your consultant's cost might be 5 to 6%, depending on the deal, of the construction costs.
Yeah.
What else do we have? You have your overhead, maybe your prelims. Your prelims can range, depending on the structure of the developer contractor. You could have 8% prelims. You could have 15% prelims. It depends on what you're extracting in terms of overheads from that deal, what margin you're going in for on that deal, and what's your minimum prelims in terms of your plant on site, your hire, your offices, your scaffolding, these sort of things. So yeah, that's like you can't get too granular because you have to make assumptions in order to get the model tricked out.
Yeah.
But generally, your rule of thumb is you're using a square foot. You're using your linear. How much linear meters of road do you have? Is there footpaths both sides, or is it on one side? So there's a rate for one-sided footpathed road, and then there's a different rate for if there's footpaths on both sides. You add in if you have planning costs, you have to add in a large chunk of planning cost. What else is there? You've obviously your cost of capital, so your cost of your money, your loan. So there's quite a range of items that you add into that.
Yeah. Nice one. JJ?
Yeah, I think we touched on this on a previous episode. Just to try and sort of slide through those. I agree with Ronan on the consultant's cost conversions. We're at about 150 a square foot plus fixtures and fittings, which we're averaging about 100k a unit in a conversion. New build, we're more or less like 275 now, plus fixtures and fittings in the units. So that is plus abnormals and externals as well, and anything in the ground. Finance 1% in, 10% per annum, 1% out at current day. What we end of July. I believe that the only things that can change on a spreadsheet is gross development value, build costs, and purchase price. Your stamp duty, your fees, your finance, all of these metrics should be auto computed to your spreadsheet because they're things that don't move that much. So make sure that you're dialing down on the purchase price, the build cost, and the gross development value more so than others. Ronan, how much you say you're like? Let's say you're building a 3-bedroom house. What's the total cost all in? Actually, in euros.
All in, I'm not sure top of my head because like all in cost brings in site cost and the site cost fluctuates. But my ground up development in terms of foundations up to finished house is about 135, 140 for a 3-bed house. That excludes curtilage, that excludes civils cost. That's pure construction cost.
Yeah, that sounds. And then is that not including fixtures and fittings?
No, we wouldn't. And that would include your kitchen, your bathrooms, your sanitary fittings, your walls painted, your ceilings obviously all painted. No finish on the floor. You've just a concrete floor. All your internal ironmongery doors, skirting, etc. Yeah.
It's about 110,000 sterling, which is cheaper than you hear. You'd struggle to build a 3-bed house for what you've just detailed. Where I am, Oxfordshire, for less than 200, really. 200
And that's
in
your pure build cost, yeah.
Yeah, that's everything you just listed minus flooring.
Yeah.
Bang a langen. And if it's smaller deals, if you're doing HMOs, then you could probably work on a cost per square meter plus your structurals and abnormalities and things like that, rather than necessarily a square foot. But square foot also works. But yeah, smaller deals, you can probably get away with just going 5
I think
bed.
on retro, I couldn't price them like my development work because it's a totally different model. Like you're going back to brick, right? Like we
Try to, yeah.
You're going back to brick in order to reduce your risk. That you're saying we're just going to pull everything back because you don't know what's behind it. So just strip everything out. Where we're building from ground up, and the only anomalies typically in those scenarios is in the ground. You usually have anomalies in what's in the ground, so that's where you can lose money in development by not knowing or something arises in there that wasn't supposed to be there.
Yeah,
Soft spots, multitude of other items that could come up.
Yeah, definitely with retrofits, especially if you're doing commercial to resi, where you may be, significantly increasing the infrastructure in the building from its current use. Then, you want to allow for a lot of abnormalities. A lot of unknowns can come out along the way. All right, next question from AH4D47. Hello, fellas. My question is that I'm 19 years old and I'm and I inspire and I aspire to be a property developer. Do you guys think that just starting to work right after high school and saving money is a better route than going to college and waste 4 years? For context, I'll be making £40,000 before tax. Is that salary good enough if I save it for a few years to fund my passion? So essentially, you're asking if you're on 40 grand a year at the moment, is that feasible for you to save up enough money to get into property development, or should you go to college? I mean, if you got 40 grand a year salary, you probably don't need to go to college. But there's a whole load of things here because you don't necessarily need the money yourself. You could raise from an investor, you could partner and do other bits. So let's throw this to Ronan first.
What
What do you
happens if you
say?
go bust? You're 28, you're 32, you've been a successful developer, but one or two sites have gone wrong. One site goes wrong, you get wiped out. You
Yep.
now don't want to be a developer. You can't be a developer. Who do you turn to? Asda? Tesco's? I think it's a better safeguard, especially at 19 years old, at 23. Plus, you're going to be working long enough. Spend some time in college, get yourself a certificate or a degree, something to fall back on. It's only 3 or 4 years. It's not like it's a detriment. It's actually good fun. You meet some nice, good people in college that you'll probably be with for the rest of your life. So, or know for the rest of your life. So, my opinion would be to get in and get your degree because development is a tricky game. I see his point in saying, Jesus, I know how to do it. I'm earning 40 grand. Um, yeah, I, maybe that's an old way of thinking, but I just think if, especially at 19, he's not like 26, 27, and he's trying to buy a house.
Yeah,
He's
yeah,
young
yeah.
enough now. Just get in and do it as a college degree, and at least then you can be very aggressive then as a developer, and maybe punch a bit higher than you wanted to be because you're young and you know you have a fallback position.
Yeah.
If you go down this other route and you're aggressive and you go bankrupt, which can happen, your fallback is very different. And if you have a mortgage, how does that mortgage get paid? Those are things you got to think about maybe 8 years down the line, or maybe he's a kid or something like that, or a family. So, yeah, that'd
Yeah.
be my advice.
Yeah, I think it just this question completely depends on your personality, your risk profile, your appetite. Me, there was no way I was doing college and I wasn't doing extended education. Wasn't going to happen. I'll happily take the risk. I'm going bankrupt, but if you do have, if you can get a qualification under your belt where you know that in a worst case scenario, your development business fails, you could walk straight into a job as a QS or a surveyor of some sort, or you might be really good at maths or something, then at least your bottom line's sorted. So getting a qualification, as Ronan says, maybe slightly older school way of thinking, but it is a secure way of doing things. But if you cannot apply yourself in education because you just want to get doing your own shit, then accept the risk and the consequences that come with that. Jack, what are you saying?
Yeah, I agree with all the points, really. I mean, college is, you're still young, you're still sort of 16 to 18. University is probably a bigger decision to make, I think, because it's a more pivotal. You're an adult, of an older age, you're not a late teen anymore. What I would suggest is go to college and do something that is relative to your bigger picture, your 10, 20, 30-year goal. And then what I'd recommend is, if you want it, you can work an extra 8 hours a day on top of that college degree, and you can work in a relative field for a company that is relative to your goals as well. What you have to remember is college isn't just about education; it's about socializing, growing up, learning other life skills that are different to just the professional outfit. And I would focusing on your career in both capacities. If you want to work 40 hours a week, you can. If you want to work 80 hours a week, you can. If you work 80 hours a week, you can do college and work. And that's always been my mentality, to always do more. I wouldn't necessarily say chase the money. I think 40 grand for a 19-year-old, is good wedge, and that's more than I pay myself in my current business. So I don't think that should be the immediate chase. I see people come out on grad schemes, join a big company like CBRE on really good money, like 50k, but turn back 10 years later and they're on 56 grand. Whereas if you worked in an SME development business and started on 30, you'd probably be more like 70, 80 OTE, and helping I'd much rather be a big cog in a little machine. And that's
Yeah.
how I like doing things. We've got 2 interns starting on Monday that are university students at Reading University, and they're doing 8 weeks work experience this summer. And the university is contributing to 2 weeks of their salary, so it's good for us because it gets them in the biz, and sort of gets them pulling a bit of weight before they start costing us. And then we've agreed that if they're good and they like the job, they can do a day a week for the last year during their last year of university. And then if they're good during that year, we'll give them a grad role to work in the business. Now, this is in a business where they will learn about everything. They'll learn about acquisitions, finding, funding, delivery, design, planning, procurement, contract management, cash flow, exit, sales, lettings, management at the back end. And to get all of that exposure in a practical perspective, as well as doing a building surveying degree from a theoretical perspective, they're going to come out way sharper than I was when I was 21 years old. So, doing the best of both worlds.
Yeah,
I mean, I would have probably worked 3 days a week at the last year of uni. I did. I worked at a hotel, but what I regret is it had nothing to do with what I'm doing now.
Yeah. I'd say get the advice to the guy who asked the question or girl. Save money, great. Be frugal, great. Do that no matter what you do. But get the knowledge. And if that means going to college and getting a domain expertise that is applicable to development, perfect. And if you really can't go to college, then the job that you get ideally is something where you are getting that exposure to the sector. Yes, hopefully helpful. I think we did a deep dive on that sort of questioning in another episode. So yeah, go have a watch of that episode as
I
well.
think it was an early one. It was like ep 2 or
Yeah.
3 maybe, where we all said what we would do if we had, because Stu said he would go and work in a big company, and I'm the opposite. I'd go and work in a 80 million turnover, 10 employee devco personally.
Yeah, that rings a bell that we did deep dive on that, didn't we? Next question, Feats Brazil. So Feats Brazil was a fan of Road Trip, the band I was in before, and she's followed me and Sonny, created a duo act called Feats, and she's always on the socials, always looking at everything we're doing, which we love. So big love, Feats Brazil. And she asked, what positive and negative contributions do you think AI can bring to the real estate industry? Ronan, you love your AI. Go on.
Yeah, I use ChatGPT quite often or throughout the course of the day. I think it's good in that it will, allow some things to be done automated as opposed to maybe having to write them out itself, reference letters, things like that. It can give you quick answers in terms to get values based on certain yields. It can spit out those things very, very quick as opposed to maybe punching it in yourself. Positives and negatives. I'm seeing mostly positives. I suppose negatives, you could make things look better than they actually are, perhaps with AI. I don't know. But I think for the moment, it's mostly positive with me and what AI is bringing. If it's enabling me to have more time to concentrate on what I need to be doing, then I find it a positive. Struggling with the negative aspects of it for the moment.
I can think of a negative. I can think of a negative.
Yeah.
I mean, I've banged on a lot about AI on this podcast, so I won't do a deep rant on it now. But I think positives, yeah, agree with everything Ronan said. There's a lot of positives that will come from it. A negative for those incumbents already in the space, like us, who are operating. The negative to us is that all the knowledge work required for us to be good at what we do, i.e., appraising sites, putting out deals, scraping data, etc. There's gonna be a more level playing field for others joining the sector, so competition could be higher on the actual the knowledge work side of development, i.e., knowing your numbers, knowing your strategy, appraising deals. That could suddenly get a lot more robust and a lot quicker and more competition. So it might be that buying deals gets more difficult. I do think that's still quite a few years away. But that if there is a negative, it's positive for the industry because it will create more free market competition, so it could help bring prices down. But negative for those of us already in the space where there may be a lot more competition that could come in aided by knowledge working AI. But Jack, go on. What do you say?
Yeah, I mean, very similar. I think obviously the biggest negative, the elephant in the room, is when AI starts controlling us and we're not controlling it. Is the biggest risk. Everything else, like Ronan said, I think is a positive. It's super intuitive. It's like almost having. I said the other day, it's like having the smartest person next to you, and you don't feel that you're bugging them when you ask them a question.
Yeah,
because when you're around someone, you're like, I've got one more question. You're like, oh,
one more.
you
don't have to say thank you either. It's great.
Yeah, you just treat it like shit. Yeah, I just love that. The other day I was working out one of our investors. asked for a snapshot statement of everything that they've invested and everything that they've earned in their investment to date. And our accounts lady is off this week, and I just put the incoming payments and outgoing payments from a bank statement into ChatGPT, and I said, this is an investor's payments in and out. Can you please accrue 8% on their money that we have accrued from all the dates? When we pay back, there's no back charge. So when we pay them back, we don't charge 8% on our money. And it spat out a statement and built a table, and I just sent it to him. And it was like, I actually sent it to our employee, and I said, this, because in our company review the other day, I said, I want everyone in our company to think about how they can use ChatGPT every hour. That's what I'm tasking our team to be doing, because I think that our team of 30 will then be a team of 90. Like, that's how effective I think it really can be. And she sort of said, this is doing me out of a job. And I went, no, I want you to do this, because I don't even want to have this chat. I just want to intro the investor to you, and you deal with it. So I love how intuitive it is. I was chatting to one of our surveyors who's super techie the other day about the integration of ChatGPT to spreadsheets, and it's just mind-blowing. You can get ChatGPT to integrate to Excel sheets and Google Sheets. You can then do a keyword search to search that question on ChatGPT per cell. So what that means is, for an example, this is irrelevant to property, but let's say you had a list of every country in the world and you wanted to know the capital city of every country in the world on a spreadsheet. It's physically impossible to do that unless you make that intuitive. So the way that you do that is you do equals, I think it's like GPT underscore search, and then you select the country and you type search criteria is what is the capital city, and then enter, and then you copy that on every cell, which takes a second, and every cell then does a ChatGPT search for the capital city, and it's intuitively then put that in that cell. So it's ChatGPT is going to be our best friends. I'm a massive advocate. I just love it. I just feel like every question you ask yourself, you should ask ChatGPT.
Yeah.
Because why not? You haven't got anything to lose. So
Fully
I
agree.
love it. And I think that in every industry, it's going to be super effective, until the point, obviously, of concern where, Elon Musk has said this time next year, he believes that there's going to be, AI is going to be smarter than humanity, which is obviously, it's concerning. It's like the whole iRobot, Will Smith movie in real life.
Sonny's coming to kill us.
Sorry, Ryan, I've got to bounce to a meeting now at 9:30.
No worries, mate. Yeah, I think that rounds us up anyway for this episode, guys. We've plowed for a load of questions there. Slightly different episode, no topics. We just thought we'd go through and respond to audience questions. So if you've got more questions for future episodes, then please comment them in on YouTube. So comment them on this episode, or send it to them on Instagram posts as well. We will try and do our best to deep dive them. So thank you everyone who asked a question. These episodes get released every Thursday at 5:30 a.m. by the way, on Spotify and YouTube. So go check them out. Ronan, our guest today, our 5th member of the podcast. Appreciated. Ronan, thanks for your time, mate. And
great to be on with you guys.
Yeah, big love. Nice one, guys, and see you next week.
Cheers, guys. Good luck.
Ta-da.
Roundup sound.